No script today. This was just too important to get out and I couldn't wait. I'm sure you've seen some variation of this chart. The stock market looks overpriced. The stock market is sitting at all-time highs. If you watch traditional finance channels like Everything Money, Thoughtful Money, or Daniel DiMartino Booth, you're going to hear that the stock market is overvalued and is destined for a crash. We see this information in aggregate, yet no one ever bothers to actually analyze the individual companies to see if it's true. Because valuation is more than just PE. You also have to factor in growth. Without factoring in growth, PE is basically meaningless. That's why today we're going to value the whole S&P index and the whole NASDAQ index. Luckily for us, these indexes are dominated by a few names. 10 names make up 40% of the S&P. For the NASDAQ, 10 names represent 50% of the index. Now, for both of these indexes, Google is counted twice because it has a multiple class share structure. For the S&P, when we click into the additional holdings, we see that JP Morgan is the next name. For the NASDAQ, when we click into the additional holdings there, we see that Palantir is the next name. When we aggregate the total names, we come up with these 12 companies: NVIDIA, Apple, Microsoft, Amazon, Google, Broadcom, Meta, Tesla, Berkshire Hathaway, JP Morgan, Costco, and Palantir. By analyzing these 12 names, we can get a good understanding of whether both the S&P index and the NASDAQ index are overvalued. So today, we're going to go through each of these names and plug them into our valuation model to see whether they're really overvalued or people just aren't measuring growth correctly. By the end of this video, you're going to have a much better understanding of if the stock market is actually overvalued. Let's start with NVIDIA. They are the artificial intelligence king. The thing that really messes people up with NVIDIA is this graph right here. People see the massive growth in the stock and believe it must be overpriced. When people see a stock go up this fast, they automatically scream bubble. But not everything that goes up fast is a bubble. The first thing you should be checking is whether there is actually growth in net income or there is expected growth coming in net income. The second thing you need to check is whether that expectation of earnings is valid. Looking at that historical price chart without looking at this net income graph is criminal. Of course, NVIDIA's share price is skyrocketing. When net income skyrockets from a few $1 billion to over $100 billion, of course the stock price is going to respond. Just look at the average growth here. We're seeing 40% annually over the last 10 years. If we zoom out to 20 years, we can still see that NVIDIA was putting up insane revenue growth numbers even before artificial intelligence was a huge thing. This translates to insane net income growth averages. And again, looking at this chart, you can see they've had huge net income growth gains way before artificial intelligence hype. Even better with NVIDIA, they are getting bigger margins over time. Now, one thing you're going to hear with NVIDIA is that competition is eventually going to erode their margins. People think that just because a company is profitable, that means that competition will come in and erode their margins and profits. Let me explain to you how stupid of an idea this is. First, let's start with Apple here. Apple makes a ton of money, yet it would be idiotic to think that a competitor is just going to come in and destroy those profit margins. People aren't leaving the iPhone. They literally will keep the iPhone just to have the correct text message bubble. Now let's look at Microsoft. Do you think that a competitor is going to replace Microsoft just because Microsoft makes a ton of money? And Microsoft doesn't even make their money off of the Windows OS. Their biggest profits now come from cloud. And Rebuilding the Microsoft Azure cloud business would take a ton of money and a ton of knowledge of building data centers that other people just don't have. Now, let's look at Amazon. Amazon is similar to Microsoft. They are another cloud provider. I know that you might traditionally interact with Amazon through delivery services, but the main thing that Amazon actually does is cloud. Most websites that you interact with on the internet are hosted on AWS. AWS is Amazon Web Services. That's what throws off the most profit for Amazon. That's not being replaced. Same with Google. A competitor isn't going to come in and erode Google's profit margins just because they make huge profits off search. People are still going to use Google. You're not going to use Bing. So the idea that people are going to switch off of NVIDIA is insanity. NVIDIA's moat is massive. You can't just make a drop-in replacement. NVIDIA's major moat drivers are CUDA, gaming, and scale. First, CUDA. CUDA allows you to develop, optimize, and deploy your applications on GPUs. That's huge. NVIDIA has been working on this for years, as they are on version 13.1 of this software. Once developers start using this, the switching costs to get them off of it are huge. Then there's gaming. Gaming is the pipeline to get people to start using CUDA. Most developers are also gamers. A developer will start off buying a GPU for gaming. Then, as they get interested in software engineering, they're going to use the GPU they already have with NVIDIA's CUDA to develop applications. And then there's scale. Because of NVIDIA's huge scale, they are a priority customer of TSMC. While NVIDIA just designs the chip, TSMC are the people that actually manufacture the chip. Because of NVIDIA's scale, they are a priority customer of TSMC. That means when TSMC releases a new manufacturing technique, NVIDIA gets first dibs on that technique. That can mean an extra 30% performance improvement or a 20% power savings. So, if you're a competitor, you are already at a disadvantage. That's why NVIDIA is so unstoppable. Alright, enough NVIDIA glazing. Now, let's plug our estimates into our valuation calculator and see what the company should actually be valued at. The first thing to note with NVIDIA is that on a forward PE basis, the company is cheap. It only trades at a 26.6 forward PE. Now, I'm also going to be conservative and say that the forward PE stays below its long-term average. I'm going to use 25. However, for our growth estimate, it's pretty clear NVIDIA has pricing power here. We need to look at NVIDIA's customers. NVIDIA's major customers are the largest tech companies in the world: Apple, Microsoft, Amazon, Google, Meta. These companies all demand NVIDIA chips, and they also have the money to pay for it. Therefore, NVIDIA can push massive price increases, and these companies are just going to have to eat it. They already have been, and that's why NVIDIA's profits have been growing at these breakneck speeds. I know people are worried that Microsoft, Amazon, and Google might replace NVIDIA products, but what do you think they were working on these last 10 years? They have been trying to make better chips than NVIDIA for forever now, and still NVIDIA holds the crown. People might be a little new to NVIDIA here, but NVIDIA has been beating these guys for a long time. You're just finally finding out. Even though NVIDIA has been growing net income like crazy, I'm still only going to forecast 25% growth. Even being conservative on both growth and projected forward PE, NVIDIA has a massive upside. This is our first company valued. Even though the company looks overpriced on a trailing earnings basis, when we look at the forward earnings, we can see that the reason why it has such high trailing PEs is because of the massive growth. When we look at the stock on a trailing earnings basis, like most people, the stock looks overvalued. It's obvious they're not factoring in the massive net income growth. When we actually value the company on forward earnings, we can see that it's actually very cheap relative to its growth and its past historical valuations. That's our first company valued and the largest company. Now let's look at our next stock, Apple. I think that this stock probably is going to end up being overvalued. Apple has outpaced the S&P, but that doesn't mean that investors are happy. In fact, many investors believe that Apple is overvalued. And the reason why is it's all about revenue growth. Apple's revenue growth has slowed to a 6% average. If we zoom out a bit, we can see that Apple was growing revenues extremely fast. Now, that growth story has slowed. Yet, Apple still commands a premium valuation. Apple's forward PE sits well above its long-term average. This is despite slowing growth. Apple's average net income growth is now only 6 to 9%. That's weak. So why does Apple command this sky-high valuation? Safety. People view Apple as a solid, reliable performer, and it's also a name that they know. Also, Apple has been steadily expanding into services. This has allowed their gross profit margin to soar. Yet, in my opinion, none of this justifies a sky-high valuation. Apple is the first name that we've encountered that I think could be overpriced. Let's plug this into our valuation model and see what the outcome is. The first thing we need to forecast is growth. Apple's growth is going to be of two components: the yield on its forward PE and its actual net income growth. Its net income growth is 9% about, and the yield on its forward PE is about 3%. If we add those together, we actually are going to get 12%. But the thing is, I don't think that forward PE of 31 is valid. I think that forward PE should be closer to 20 given its slow net income growth. When we plug that into our model, we get a 35% downside and a forecasted return over the next 5 years of 14%. That downside risk is massive. Now, Apple might be able to grow faster than 12% and continue to justify its higher forward PE if they are able to continue to expand net income faster and faster through expanding their services. Apple has many subscription services like Apple One that are very high margin. As Apple's revenue continues to grow from those types of services, net income could accelerate. However, I'm not willing to bet the farm on that. I don't think the risk of forward PE compression is worth it. On top of that, net income growth could still slow. So with Apple, you're primarily betting on things like Apple One, Apple TV, and Apple's new Creator Studio. These types of services have high margins and can eventually grow net income fast as you increase the subscription price. I don't think that type of bet is worth it for Apple. Now, let's update our table here. Apple is our first stock that we find to be overvalued. However, NVIDIA is undervalued enough to offset that. Let's continue with Microsoft. Microsoft has extremely stable revenue growth. Their revenue business model is amazing. They have been able to get many customers to switch to a subscription model. That means customers are going to be paying forever. Microsoft's primary products are the Microsoft operating system and their Azure cloud. Their Azure cloud is the new profit center. What's truly amazing for Microsoft is how stable the revenue growth is. Microsoft continues to grow revenues at around 10 to 13% despite being a massive company. You'll hear on channels like Everything Money that big companies can't continue to grow revenues at breakneck speeds. Yet, Microsoft shows you that this is still possible and big companies can continue to get even bigger. Now, the more exciting thing with Microsoft is their average profit growth has been even greater. The 20-year average is amazing. However, when we zoom in to the 10-year average, it looks even better. When we look at the 10-year averages, we can see massive growth. Now, if we look at the forward PE for Microsoft, we can see that it's been expanding. However, it probably should have never been trading under a 20 PE in the first place. When you're averaging 15% net income growth, you deserve a high forward PE. Right now, Microsoft is right in line with their 10-year averages. Let's plug this into our valuation model and see what we come up with. Let's start with our growth estimate. I'm going to pick a growth estimate closer to their top line growth than their net income growth. I'm going to assume that there's eventually a limit on net income margin expansion. So let's use this 12 to 14% number of revenue growth and say that our earnings growth on average is 13%. Also, let's get some yield from the forward PE of about 4%. If we combine that together, that's about 17% growth. The company trades at its long-term forward PE average, and I think that that's an accurate assumption. So I'm going to leave the forward PE at 27.7. So when we put all that into our valuation model, we can see that Microsoft is actually a little underpriced. That might be surprising to some people, but again, this company is growing revenue and net income at breakneck speeds. There's a reason they call these companies the Magnificent Seven. It's because they truly are magnificent. Let's now update our summary table to see where we're at. So far, we're seeing that the market is underpriced. I know that's surprising, but let's see if that trend continues with Amazon. Amazon's shopping business is essentially just a side hustle for Amazon. I know that sounds crazy, but the real profit driver for Amazon is AWS, Amazon Web Services. AWS is the backbone of the internet. When AWS goes down, the internet goes down. For example, if your Netflix is not working, that's because AWS isn't working. Netflix uses services like AWS to provide you streaming video. Amazon and Microsoft together are the cloud leaders. You would think it's Google, but Google actually doesn't have that many servers compared to AWS and Microsoft. We're going to go into that later with Google, but that's a massive growth opportunity for Google. The sheer dollar value of Amazon's revenues are insane. You're looking at almost $700 billion in revenue. Many people compare a company's market cap to a country's GDP, but that's wrong. The real thing you should be looking at is revenue. That's more equivalent to GDP as it's measuring economic activity. Amazon's total revenues are inflated by their shopping side hustle. Amazon doesn't make that much money off of shopping, if any. The beauty of Amazon is how fast the revenues are growing, even when total revenues are $700 billion. Again, this is why I laugh at people like Everything Money. People like this will tell you that it's impossible for large companies to grow revenues at breakneck speeds. Yet, you see a company like Amazon continue to do this. Amazon never focused on making a profit, which is why the company's profits sit at zero for such a long time. Eventually, though, Amazon couldn't figure out a way to spend all of its money. Normally, Amazon spends everything on reinvestment. Now, though, with $700 billion of revenue coming in, it's impossible for them to spend it all. So now, Amazon is throwing off massive profits, and shareholders definitely aren't complaining. That net income is growing extremely fast now. You're getting such massive net income growth that it breaks my scales. Net income margins are finally expanding, so every additional dollar of revenue is more profit. Now, the best part here is you're getting all of this growth for a 32.1 forward PE. That looks expensive, but when you look at Amazon's long-term forward PEs, it's very cheap. You also have to consider net income is growing at breakneck speeds, and the company for the majority of its lifetime wasn't even trying to make money. With the important financial metrics out the way, now let's plug these numbers into our valuation model and see what we come up with. The first thing we need to estimate here is earnings growth. Net income growth here is massive, and I don't think it's going to slow down for a while. Amazon is finally trying to make money and monetize its business. So I think that their net income growth will continue to grow at breakneck speeds. I'm going to forecast 25% net income growth. I'm not going to give them any additional for earnings yield because Amazon's share count continues to expand. Amazon cares more about reinvestment than returning money to shareholders. It's going to spend all of its net income eventually on growth, so there's no point factoring in a yield. I do think that their forward PE will contract slightly. However, Amazon is growing at such a fast speed with such stable earnings that I think that people are going to be willing to pay a premium for that growth. So with all this in our valuation model, we see a projected 185% return over the next 5 years and a 62% upside. Now, let's add this information to our summary table. With 4 names done now, we are starting to see a trend emerge. Stocks that look overpriced are actually fast growers. When you factor in the growth, there's a lot of upside in these stocks, even with the high forward PE. What I think is going on here is that people are not used to such big companies growing so fast. Let's see though if this trend continues with the last 8 names on our list. Google is another name that when people look at a chart like this, they assume it must be a bubble. Again though, what people aren't factoring in here is massive net income growth. Google's revenues are stable, and that should be obvious. Their main business is selling ads on Google Search and YouTube. They also have a bunch of subscription services. As I've said before, and I'll continue to say, these large companies are growing revenues at breakneck speeds. Google has been averaging around 18% over the last 10 years. That means that large companies can continue to put up amazing earnings numbers. Normally, in your finance class, you decelerate growth to a long-term average of 2 to 3%. Yet, if you had done that in your models for any of our companies that we have analyzed so far, you would have missed out on massive growth as that growth runway continued long past what our financial models are used to. This is why so many people are screwing up valuing these massive companies. They are forecasting that growth will decelerate to 4 to 5%, but that just doesn't happen with these companies. They have continued to grow at 13 to 15%, breaking these people's financial models. Just looking at this graph makes me laugh. When you look at the long-term growth, these numbers are ridiculous. 21 to 28%? Of course this company is going to trade at a high forward PE when it's putting up numbers like this. I don't think there's many other financial numbers that you need to look into, so let's just jump straight into the valuation. You should already know what Google is at this point. Google is trading well above its 10-year forward PE average. However, I think given its growth, this is warranted. Still though, I'm going to factor in some PE compression because investors love their long-term averages. Let's say that the forward PE contracts to 25. Now we need to estimate growth. Also, we can add in yield because Google is spending a ton on buybacks. Between both growth and yield, I'm going to forecast 25% growth, and this is probably being conservative. Even with forward PE contraction, their growth rate is so high that there's still upside on the stock. Now, let's update our summary table and continue. Our next name is Broadcom. Broadcom is a company that was formed through a massive amount of acquisitions. However, the business that's most important to us right now is their networking business. Now, when I'm talking about networking, I'm not talking about the LinkedIn type of networking. I'm talking about how computers communicate to each other. Why is this important? Artificial intelligence. Artificial intelligence demands more computing power than one computer can deliver on its own. Companies like Broadcom offer networking that allows multiple computers to work together. This basically lets Tons of computers operate together as one supercomputer. And this is important now because artificial intelligence takes increasing amounts of compute power to operate. Now, when you hear about companies being in a bubble, you've probably heard about the name Cisco being thrown around. You've probably heard NVIDIA be compared to Cisco a ton of times at this point. However, Cisco was in the business of networking. Therefore, it's much more accurate to compare a company like Broadcom to Cisco than NVIDIA. Broadcom is also in networking, and their stock has now shot up. My main fear for a company like Broadcom is that they are in a similar situation to Cisco. Artificial intelligence needs the best networking capabilities for the computers to work together as one supercomputer. But the question is, will networking needs increase at the same speed as artificial intelligence compute speeds? I'm not sure, to be honest. Currently, Broadcom's revenue growth looks amazing. Their net income growth is off the charts. With such strong net income, Broadcom is hard to ignore. But yet, the parallels with Cisco are hard to forget. Broadcom is trading far above its normal forward PE levels, but its net income growth warrants that. That said, for my valuation model, I'm going to forecast them returning back to their normal forward PEs. I still think this company has a lot of growth ahead of it. Let's see how this company looks in our valuation model. The first thing I'm going to forecast here is growth. Even though I'm worried about the parallels with Cisco, I still think that over the next 5 years, we are going to need a lot better networking. That gives Broadcom at least 5 years of runway for net income growth. Based on how fast revenues are growing, and that net income is growing even faster, I'm going to forecast about 30% earnings growth over the next 5 years. However, when it comes to the forward PE, I'm going to guess that it contracts all the way back to 20. This isn't really because I believe this, as much as I'm trying to capture the uncertainty of the Cisco parallel. I've never been a fan of networking stocks ever since Cisco. That has scarred me as an investor. Now, I could be wrong about this parallel, but because I haven't had the time to play around with networking on my own home servers, I don't know whether it's a good deal or not. Even factoring in this forward PE contraction though, we still have upside on this stock. This stock is still expected to outperform the S&P average return, even with such huge multiple contraction. Again, it seems like all of these companies that we are analyzing here are experiencing massive growth surges. Let's see what our updated summary table looks like now. Alright, now let's look at Meta. Meta is another stable revenue growth company. This advertising giant grows revenues extremely fast. 20 to 30% revenue growth for Meta is normal. While the company is getting laughed at for the metaverse, they are printing money. Yet for some reason, Meta's forward PE never reflects this. They regularly are trading at a discount to their average and a discount to their peers who have less growth. Just look at these insane net income growth numbers. Net income is massive, and yet investors continue to doubt this company. Now, you might not like Meta because you don't like Facebook, you don't like Instagram, you don't like Mark Zuckerberg, whatever. I personally don't care. What I care about is whether a stock will make me money. Meta trades at a cheap forward PE and has huge net income growth. Let's see how that plays out in our valuation model. First, with our valuation model, we're going to forecast the earnings. Their average net income growth is somewhere around 45%, but that's such a huge number that I don't even feel comfortable putting that into my valuation model. I'm going to use their revenue growth number for something a little more realistic. Even still, that's huge. I'm going to use 18% because their revenue growth has slowly been coming down. I'm also going to factor in a 5% yield for a total earnings growth of 23%. Meta never gets the projected forward PE it deserves, So I'm going to forecast a contraction here to 20. With these numbers plugged in, we are seeing a massive upside on Meta. Again, this is all being driven by earnings growth. All right, with Meta now plugged into our summary, now let's look at Tesla. Tesla is going to be a little tricky here. Tesla's valuation has nothing to do with its current earnings. Tesla's valuation has everything to do with its projected future. Tesla's entire valuation hinges on Robotaxi and the Optimus robot. Now, I already have a video detailing my valuation on Tesla based on the Optimus robot. However, I hadn't factored in the Robotaxi at that time. My belief at that time was that the Robotaxi was vaporware. Now though, I think this has real earnings potential and it only further boosts my valuation of Tesla. I'm going to hold off putting this into our valuation model and we're going to come back to Tesla at the end. Now, let's look at Berkshire Hathaway. Berkshire Hathaway shouldn't need an introduction, but if it does, it's Warren Buffett's investment piggy bank. Berkshire Hathaway is an investment company LARPing as an insurance company. It's hard to value Berkshire Hathaway because its main draw is its investment portfolio. The main thing you're getting with Berkshire Hathaway is Warren Buffett as your investment manager. But things have changed at Berkshire Hathaway. Warren Buffett is now officially retired as of the start of this year. Now there's new management in place. When we look at Berkshire Hathaway over the last 10 years, we can see that it mostly lines up with the S&P. While Warren Buffett has been praised as an amazing investor, over the last 10 to 20 years, he's only matched the S&P. Most of his outperformance comes from a long time ago, when the stock market was a lot less competitive. Now, as the stock market game has got a lot harder, Warren Buffett has put up more average performance. This matters for our valuation because essentially the growth of Berkshire Hathaway is just going to be the average growth of the stock market. So the main thing that you need to do is buy the company at an attractive forward PE. Because the long-term growth pretty much matches the S&P, I'd want to buy this stock at a similar forward PE to the S&P 500. When I pull the S&P data onto this chart, I can see that its long-term average for its forward PE is around 20. Now, let's put this into our valuation model and see what we come up with. For our valuation model, we're going to use 12% growth because that's the average growth of the S&P, and Berkshire seems to match that. The current forward PE is 22.5. However, when we look at the average of the S&P's average is around 19 to 20. Plugging that into our model, we see a slight underperformance of the S&P. Plugging that into our investment summary table, this is our second stock that we found that has downside risk. We can see that the primary reason a stock won't outperform is because its growth forecast is weak. Many of these names are trading at elevated forward PEs, but their growth forecast is so large that it overcomes that. Apple and Berkshire Hathaway, however, are the few stocks on our list so far that have weak growth forecasts, high forward PEs, and therefore end up having a low future forward projected return. Next up, JP Morgan. I'm predicting this name will be in line with the average. JP Morgan is one of the best banks in the world. They have what they call a fortress balance sheet. That means they are the most selective banks when it comes to lending out money. JP Morgan has pretty stable revenue growth because of this. Their revenues grow at approximately 6%. This is actually right in line with the growth of the money supply in the country. Net income for JP Morgan grows a little faster, anywhere between 8 to 12%. The main thing to look at with JP Morgan is picking it up at a favorable price to earnings ratio. Right now, the price to earnings ratio is a little elevated. The reason the forward price to earnings ratio is so important for a bank is the main way a bank is going to return earnings to you is through dividends and buybacks. The lower the forward PE, the higher that dividend yield and buyback yield is. With JP Morgan, the first thing I'm going to forecast is their earnings growth. I could use the higher net income earnings growth, but I'm going to be conservative and use their revenue growth that lines up with the money supply growth. That's 6%. I'm also going to factor in their forward PE yield from the 14.5 forward PE. That gives us approximately another 7% growth. If we combine those two, we get 13%. If we look at the long-term forward PE, I predict this is going to contract back to its long-term average. Personally, though, I think it should be trading at a 14 PE about. Factoring all of that in, we have a slight downside from today's price and a slight underperformance compared to the S&P 500. Next up, Costco. I've already covered Costco on the channel, and I already know it's going to end up being overpriced. Let's see just how overpriced it is. Costco has very stable revenues driven by its subscription model. This leads to very stable revenue growth. Essentially, Costco offers its items at the lowest profit margin it can. The way Costco makes its money is through its membership model. Costco charges you an annual subscription. That subscription is basically pure profit. This is what allows Costco's net income growth to outpace its revenue growth. However, this is Costco's problem. Its forward PE sits at a massive high. Now, I'm going to actually say something controversial here. Costco's high forward PE actually is warranted. Because Costco's revenues are so stable and its net income growth is so high, if Costco's forward PE were to drop more, it would just boost the company's earnings growth even higher. Let me show you how that plays out in our valuation model. Okay, here's our valuation model for Costco with everything at a neutral standpoint. Now, let's factor in their earnings growth of about 13%. Then, let's also factor in yield from the forward PE of about 1.5%. Now, the main risk for Costco is forward PE contraction. This 46.8 PE is very high. However, there's a reason why people are willing to pay such a high forward PE for Costco. That's because the 13% earnings growth is already strong, and it's reliable. This earnings growth comes from Costco raising the annual subscription price. A very small increase in that price leads to a massive boost in net income. Because of the stability of that earnings growth, people are willing to receive about a 2% yield, knowing they're going to get 13% growth over time. People are willing to accept that 2% forward PE yield because the earnings growth is extremely stable. When investors see a net income line that's this stable, driven by a consumer staple that middle class to affluent customers are purchasing, they get excited. That's why Costco trades at such a high forward PE. With all of that said though, I'm still going to be conservative. Yes, I will give them the 13% earnings growth and an additional 1.5% yield from the forward PE. However, if the forward PE were to stay stable, you would still be getting upside on Costco. However, I'm going to be conservative here and drop the forward PE all the way to 25. That results in a massive 40% downside risk and only a 5% return over the next 5 years. This is the most conservative scenario because realistically, I think they'll still be able to command a high forward PE because people like dependable, fast-growing companies. All right, we've got Costco on here. We have one more name to look at, and that's Palantir. Palantir is a very controversial name. While many look at Palantir as some type of crazy surveillance system, in reality, all Palantir is a more advanced enterprise resource planning system. Palantir's goal is to give executives at a company a full 360-degree view of their company. Many functions in a company are on different softwares or siloed in different regions. Palantir's aim is to bring all this information together so that it can work off one system. The crazy thing with Palantir is able to let you use all of your legacy systems, and somehow they are able to hook into all of these systems and pull all this information into one central truth. Palantir just became profitable, and their massive $407 billion market cap has nothing to do with its current profits. Similar to Tesla, this company is all about insane future growth projections. This is actually even harder to value than Tesla. Given the complexity of rolling out Palantir to new customers, it's very hard to figure out what their growth potential could be and how many people are willing to adopt such a controversial software. On top of that, Palantir's CEO, Alex Karp, has specifically gotten himself involved in the culture wars. Because of the fact that Palantir has so many government contracts, there is a non-zero chance that a left-wing government coming into power could cancel these contracts. Alex Karp is no fan of the left wing, calling them the woke left, and it will be very hard for left-wing politicians to justify renewing those contracts. Alright, so here now is our final list. Now we can see that we have valued most of the stock market. We have valued $24 trillion worth of companies. We're going to ignore Tesla and Palantir as they only make up $2 billion of market cap, or about 7% of the market cap of the companies on this list. There are some important summaries we can take away from this. The first thing is, outside of Apple, the majority of the companies that are considered to be overvalued by our valuation models are companies with smaller market caps. Most of the top companies have massive earnings growth. That's why their PEs are so large. The weakest names all have earnings growth below 15%. Now let's take a look at the target market cap. Our target market cap forecast doesn't include Tesla or Palantir. We left those blank as those are massively hard companies to value. Even with that $2 trillion of market cap left blank, we still have a valuation of these top 12 companies of $30 trillion. That's compared to their current market cap of $26 trillion. That's quite remarkable that even with Tesla and Palantir going to zero, there still could be 18% upside in the market. However, what if we did value Tesla and Palantir? Let's say that instead of going to zero, they suffered 50% losses. Now, instead of there being 18% upside, there's 21% upside, and our future forecasted market cap is $31 trillion. That's already a lot of upside in the market, but what if these companies are actually valuable? Let's say that they're so valuable that they more than double in market cap. Now, there's a 33% upside. This is why I say the stock market isn't overpriced. It's because I actually bottoms up have valued all of the companies. I've done 10 of them for you today, but as you can see weekly, we are constantly valuing these companies. The truth is, the idea that the stock market is overvalued comes from people who are too lazy to do work like this. Instead, what they do is they look at a chart like this and they say the forward PE of 31 is way higher than it ever has been in its historical averages. Because they are looking at the historical average and never bothered to look to see if these companies are truly magnificent, they don't know that these companies are not average. Using the average makes zero sense when you're analyzing companies that are performing above the average. The stock market is growing because so many companies are growing at breakneck speeds that were never possible in the past. When you look at a chart like this, you're factoring in time periods from the 1900s when you could only grow as fast as you can move a product physically. Today, we have tech companies that can sell things digitally in seconds. That changes the growth trajectory of companies and the economy. This stuff is basic, and you would think that these people could figure it out. But I think they can't because they are lazy. People are lazy and they don't like doing math anymore. And so basic analysis like this appeals to them. It doesn't require a lot of brain power. They simply look at the current PE, compare it to the median, and say, overvalued. None of this work was done. If they had done this work, they would realize there is so much more upside for the stock market. All they have to do is correctly forecast growth. I know this was a long video, but I hope you stuck with me to the end. You can see that yes, stocks are trading at elevated forward PEs, but that doesn't mean that their valuations are elevated. In fact, as we can see from our analysis today, many of these stocks are underpriced even with high forward PEs. The main thing you should take away from this video is how important it is to forecast growth correctly. If you aren't forecasting growth correctly, or you don't understand how high growth affects a valuation, you might think a stock is way more overvalued than it is. Let's take a look at the stock with the most upside on our chart, NVIDIA. If we only look at trailing PEs, this stock looks extremely overvalued. If we don't look at anything else but PE, like many investors do, we would miss out on this. We would think, oh, gross, overvalued, I'm not going to touch it. When we look at the forward PE and net income growth numbers together, though, that tells a different story. This is the critical thing that you will learn watching this channel. You're going to get real analysis, not a person doing lazy average work. That's it for today, guys. If you found this helpful, hit like. If you want me to do more videos like this, let me know in the comments. If you've stuck around this long, I really want to talk to you. You definitely enjoy investing as much as I do. Please join me on Discord. Link in the description. I'm a real person and I want to talk to you. Thanks. Bye.